Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, June 20th, 2019. All right, let's dive into the charts. We have some developments worth noting. Start out here, a couple things. We'll start out with the daily charts, and what I want to point out were the candlesticks that we printed today. So we have pretty much a dragonfly doji here on SPY. That's this tall candlestick. Now, those are, and I have to emphasize the word, potential reversal sticks. Just about any single day candlestick, whether bullish or bearish, is a potential. I like to, most candlesticks should be confirmed with follow-through candles. In other words, a 2 or a 3-day candlestick pattern, because a lot of candles, randomly can print. But for example, I talked about we had a nice bearish engulfing candle there, and then it was followed through with a red candle and a close down below it, and we never went back above it. So that's what we need to see here. The ideal scenario on a dragonfly doji is to see a candle that stays below. If we could gap down below that candle and close, that's a get out of Dodge moment. But as long as we, open tomorrow, a lot like the bearish engulfings, I prefer to see prices remain below the midpoint, no more than 2/3 above, and then again, need to see a close down towards the bottom. And as I always say, using a little slang, the redder the better. As any potential candlestick, just like those trend lines that I covered yesterday on the 60-minute charts, which I'll get to again, there's levels to watch for, but there's no sell signals triggered until and unless you get that follow through. So that's what we have, and let's just run through a couple of the others. We have this close to pretty much a hanging man candle. That's you have a little bit wider body there than the doji, and usually you want to see that body about twice the size of the candlestick shadow down below, which is about what it is there. That is also a potential bearish candlestick, and like the other ones, you want to see some follow through, some confirmation, close down below. And so that's what I'll be watching for tomorrow for potential sell signals there on QQQ. Even the Dow, DIA. I like to use the ETFs in these analysis because that's what people trade. You're not trading the DJIA. You can trade futures, and I get to those charts too, usually during the videos. But so here's DIA with a nice doji as well. And again, these are potential topping sticks. And you don't want to really put too much into it if it would have come right here after 3-4 day advance. But when you've gone from oversold, down on the 30 level to overbought in one fell swoop like this, that's when you start looking out for topping sticks after any extended run, but especially when you have other things that line it up. So there it is. That's the Dow, all the major large cap indexes, the Dow, QQQ, and SPY. So let's go back to look at a couple levels here. Let's go back to SPY, and here's what else we have. When I zoom in, probably the big news, and what I'm sure I'll hear about, is the new highs in the S&P 500. What I posted on the site today was the fact that the S&P 500 and the markets, most indexes, by the way, almost all, the majority, are still below their highs right now. So the SPY eked out a new high, but we didn't have that in QQQ. We didn't have it in the Dow. We certainly don't have it in the mid caps or the small caps or anything else. So again, the stock market collectively is still, especially the lower end stuff, is still not at those highs. But take it for what it's worth. We closed up green. We got to give it to the bulls from that aspect if you're doing check marks for the day. But let's see what happens. Now, what I wanted to mention here is the S&P 500, for example, and a lot of these indexes, but more so the S&P, has a series of making marginal new highs. So you had this was an all-time high right here, followed by a sharp drop, and then it took us about, 9 months, almost 10 months later, and we popped it right there, eked out to a marginal new high. It was a divergent high. There were all kinds of setups, no sell signals until we broke the trend line, but all types of setups and indications that breakout would fail. That was the expectation back then. Made it very clear. and more importantly, not just talking about the potential for reversal, but the day it came with the breakdown in QQQ and XLK in the tech sector, just like back here. So my point here is this is the MO, if you will, for the market in over the past, it's been almost a year and a half now. So you go up, eke out a marginal new high, markets are overbought, there's divergences all over the place, and then boom, big drop there. So that was a drop. We did it again right here. This was almost immeasurable, but it was a slightly higher high, just like this one today. We're talking basis points, a marginal new high, less than 1%. And same story. We popped to new highs, and what did they do? They sold it again. Was it just, coincidence, the fact we went to new highs? No, not really, because you can see back then we had, negative divergences, clean up trend line, other developments on other indexes, especially the tech stocks, and that's what said don't chase that breakout. Some breakouts to new highs are bullish, and they usually are, not all of them. Those that have, again, like you can see here, at this point in time we had divergence, mostly you can see on the PPO down here. This was a lower high. On the PPO, we had almost about flatline divergence there on the RSI with a slightly higher high. Now we have clearly, divergence on both. You can see the PPO making lower highs, RSI making lower highs, why prices made that marginal new high, plus that candlestick there. Be a different story if we, and it could be if we continue to power on through there, and that may be the case. But I just wanted to point that out. So there it is. And as I said in recent videos, if we went higher and eked out to a new high, it's not going to change anything in the at least at this point in time. That has the potential to, but at this point in time, it doesn't change anything in the technical posture of the indexes, other than now giving us a divergent high in the SPY. All right, so let's go back down to those 60-minute charts. We'll start with the futures. We'll keep this video short. These are the 60-minute charts, and you have these clean wedges working their way up, fully mature. And again, this was covered in the video earlier today for members. So a bit of a recap, but to me, pretty simple stuff. Doesn't guarantee it'll play out, but this, here's again, this is when we can see these highs come in. And there we had a very clean uptrend line, even goes to the left of the chart. Uptrend lines are not sell signals nor divergence. In fact, they're buy signals. You can buy back, pullbacks to support. But when you start getting overbought and you get the negative divergence, that's when you're on the lookout for a breakdown, and we got it. Boom. So this was clean. That marked the top. That led to that drop. That drop, as we all know, ended with, you got it, divergent low, bullish divergence right there. So this is the wash, rinse, repeat stuff, and this is why this new high to me, just other than the fact it's a new high, that's irrelevant. Maybe these patterns get burned through. As I said in yesterday's video, I think I had that divergence line right there, and I said, that's only the divergence line. This is not a trend line. In my opinion, this is a trend. This is your uptrend right here. The security can move all over the place on the upside. This is just simply a divergence line highlighting the fact that prices are making higher highs with your indicators not. They're making lower highs, and that is what we call negative divergence. Just a sign of waning momentum, that's all. And they usually precede breakdowns. So this kind of meshes with what we're seeing right now on the daily charts. If we reverse tomorrow, if we have a red day, especially a big red day, and we can break down and make a solid close below these, well, first of all, that would trigger the sell signal, the same one I mentioned yesterday. We need to see these break. Since yesterday, all we did is tag that level again, move up within the wedge. We're wedging higher. So that's ES, and let's look at NQ. NQ is the NASDAQ 100. ES, by the way, is the S&P 500 futures. That's what we were just looking at. And here's NQ, same story. So there's your wedge, there's your trend line. There's also some decent support here, pretty good support level, about 76.95, call that 7,700. You can see all these reactions back here as well. So those are levels to watch. And, until and unless they go, we don't have any sell signals yet, but that's what we'll be watching for. If that breaks down and this plays out as one would expect, in other words, with an impulsive move, and we print a solid red close, again, that will then also give us those potential sell signals or confirmation on those bearish sticks or potentially bearish sticks out there on the daily charts. All right, let's look at one more for you. Every now and then I like to cover the Russell 2000. There's a chart right there. You can see you can see the pattern of divergent highs and lows. I don't need to really mark it. All the lines are on the indicators. And then you get this little wedge going right here. So they're all in alignment. The charts are in alignment. In other words, SPY, if the market can drop 1% tomorrow, 2% for sure, or in the next couple days, maybe tomorrow's Friday, they might park it and just leave us all guessing right here on these trend lines. That wouldn't surprise me one bit. I think someone mentioned, yeah, we maybe have options expiration tomorrow as well, so we might get some volatility. But either way, this is what you're looking for. So if you're trading, IW or RTY, the small cap ETF, you can see some targets that I have down here. You can also see a resistance level just above. I posted this one earlier today. 1577 and a quarter or so is a pretty good level. You can see a lot of reactions from above and below there. So that's kind of where we're at, pinched between, in this wedge, reversed off some resistance today, and but stayed above trendline support. So this movie will have to be continued tomorrow. One more, we'll look at the index 60-minute charts. And that's it. I mean, they look a lot like the futures I just showed you. This is SPY, the S&P 500 tracking ETF. So we have a couple more reactions today on that trend line. That helps to validate it. The more reactions you have, I like to say at least 3 separate distinct reactions to create a trend line, because any 2 points can be connected at random. Again, that's just a divergence line for the wedge. Can go up, can go down, as long as we don't take out the previous reaction highs on the indicators down here. We still have that divergence there. So it's that same negative divergence up here that was a catalyst for that drop. It was the same bullish divergence down here that was a catalyst for this rally. And there's certainly the potential right here for the same divergence. It could extend. We could work our way up here. I know I'm making a mess now. It looks like a 3-year-old's drawing. But you can, like I said, you can extend out here, come on up, as long as you don't take out those divergences. And if you do, then we continue higher, and it'll also wipe out those candles that we put in today on the indexes that I showed you on the daily chart. So there's the levels to watch. Pretty easy trend lines to replicate. QQQ, you can see again just quite a few reactions. It starts off the lows, and you have some reactions along the way. We're dancing on that as we're wedging higher. And there's QQQ. Well, tried to draw a line there, but there's your previous highs right there. And so we're a little shy of that. Tomorrow's OPEX, so maybe whether we make a run at it, whether we try to pop them, or who knows, anything's possible. I have no idea. Maybe this thing breaks down overnight. Maybe we continue up on here for another day or into early next week, or maybe we just keep on going right through. Anything's possible, but I'll watch for a breakdown. And not only a breakdown, you want to also see a close. You could break down and whip on up and back test those, but ideally, again, for those daily candles, you want to see a breakdown. And then if you do break down, I'll tell you, watch this level right here again that I think I mentioned yesterday, 185.95, we'll call it 186 or so, a pretty big level on QQQ. So right now, like I said, we're up, but this is still post FOMC noise from my experience on the big market moving FOMC meetings like this. The initial reaction, not just at 2 p.m., not just the sharp spike or rip or dip, it's the reaction that you have for the next day or two. And you always have announcements on the regularly scheduled meetings come on Wednesday. So it's sometimes we'll see the market go one way or the other. Sometimes it's down, sometimes it's up, and that can happen for a day or two until you reverse. So I always caution that the initial reaction is not always the lasting reaction, and quite often it's not. So these are the levels I'll watch, and we'll go from here. We'll pick it up tomorrow. I think that's everything I wanted to cover today. Let me check. No, I'll say this. This is we're seeing some very odd behavior in the market right now. Stock market's rallying up near the previous highs right now, and yet treasuries are rallying and have been rallying strongly and are still moving in lockstep. That's unusual. That's showing you a couple things. One of those is a flight to safety, and you can see gold too doing the same thing. So there's something isn't right with a rally when you're seeing gold and treasury bonds, the two king of flight to safety assets, king of risk off assets, all rallying very hard. I mean, this is a big run up in gold, big run up in treasury. So You know me. Maybe I'm erring to the side of cautious. Maybe I'm seeing things that aren't there, and if not, we'll know soon. As I said, I gave it a little more room today because again, it's a post FOMC day, and there's those divergences, the wedges, the bearish candles, and everything else. So I'm still sitting tight on what I have short. And we'll do so for not much longer because they're either going to foil those patterns tomorrow. OPEX days are nasty too because sometimes you get a lot of back and forth, but we'll see. Again, I always say the charts are dynamic, and so is my analysis. So we'll just pick it up where we left off tomorrow and see how things go. This has been Randy Finney with Right Side of the Chart. Have a great day.